how to get a loan to buy real estate. Finally, you're going to see the insider secret so you kind of know what's going on as you try to get a real estate loan. You're going to see the ratios you need to have, the credit you need to have, and we're going to talk about how the industry looks at you in terms of deciding whether or not to give you a loan. Having been in the mortgage business, I'm going to pull back the curtain and I'm going to show you what the wizard is doing back there behind the curtain with your credit and your income and your loan application. So let's dive right in. So you want to buy a property, you want to buy a house, and you're wondering if you're going to get a loan. So here's what they're looking at. They're looking at your credit, okay? What is your credit? A credit of 580 or higher, you may be able to get a loan. 640, you're probably going to get a loan. 680, you're going to get a loan. Above 680, you're going to get a loan, okay? In terms of your credit. Now, some of you say, well, my credit sucks. Okay, you know what? Your credit might suck and it might not. You know, I'm a landlord and I do applications for people applying for places to live. And you know what they always say? My credit's not that good. And you know what? Sometimes it's not that bad. Sometimes it's not as bad as you think it is. Credit is not granite. Credit is clay. It's moldable. It changes over time. It's dynamic. So things can happen on your credit that cause it to go up or down. One of my good friends owns a credit repair business, and he has helped so many people to improve their credit by simple things that they could do that have nothing to do with getting things off their credit, but changing the ratios of how much they have available to use and how much they're using. That's not the purpose of this video. We'll cover it in a different one, but I want you to know, for terms of credit scores, these are what they're looking at. This is where it's at. Now, let's say you're below 580 and you want to get a loan. You may be able to get a private money loan. Private money, private. What does private mean? Private means that it's a lender that's not an institutional lender, because the institutional lenders have a lot of rules and guidelines that they have to go by, and they have to look at credit in terms of these scores. And guess what they do based on the scores? They adjust the pricing. Remember, we talked about in another video, if you haven't watched all my videos, you better. We talked about pricing, and pricing is what? How much they're going to charge you for the money. The better the credit, the lower the interest rate, right? You know, Susie Orman and other people talk about that all the time, and they do it very well. So the pricing of your loan is going to depend on your credit score. Your credit score is not granted, it's changeable over time, and there's ways to change it. The next thing they're going to look at is your income, okay? How much money do you make? What is your income? Is your income from a job or is it from self-employment? If you're self-employed, they're going to want 6 to 12 months tax returns to see your cash flow. I live in Vegas. We have a lot of people that actually just get cash and they don't put it all in the bank. They pay their bills with the cash. The challenge with that is when they go to get a loan, because they never put any of their money in the bank, right? They don't have any way to show they made the money. So it's important that you run your money through your bank account, or have some, even if it's Venmo or whatever, so you have some documentation of your deposits, PayPal, whatever else it is. If you have a job, they're going to use your W-2, and they're going to take that income, whatever that number is, right? And they're going to start doing some formulas. And that formula is, what can you afford to debt service? Okay. How much debt can you afford? Maybe you have a car payment that's $300 a month. Your rent is $1,200 a month, and you have $60 a month in credit cards, okay? So you have $1,560 in bills you have to pay every month. All right, this is just an example, okay? So what's the minimum on the credit cards? How much were you paying in rent? And what were you paying on your car payment, okay? So they're gonna look at all that and they're gonna say, well, these are debt service that you have to do. This rent's gonna go away if you buy a house, but you're going to have to make a payment, and we wanna make sure you don't have payment shock. So if you're paying $1,200 in rent and now you're gonna pay $3,600 on a mortgage payment, that sounds like payment shock, okay? But $1,200 to maybe $2,000, well, that may not be payment shock. So that's one of the things they're going to look at. What have you been paying for housing, and what is your new loan going to look like in terms of your income and your ability to look at it? Another thing they're going to look at is your ratios. What's your debt to income ratio, okay? There's called the front end and a back end. The front end is a ratio of what is your mortgage payment compared to your income, okay? So if you made $3,000 a month, and your total payment, right, was $1,000 a month, then that would be what? 33.3%. That would be your ratio, okay? 33.3%. They like to see your payment to income for your house around 32 to 35%, okay? Right in that range. So, and then they want to look at your other debt to income, and they want that to be somewhere around 40, 43. Some loans will go as high as 45 to even as high as 50. It depends on the lender and what program they have and what they allow. If somebody was at 45, 46, 47, they may have an $8,000 a month income. So even though they're at, almost 50% for housing and all that, they have so much extra cash that they can handle it for all their other bills. Or somebody who has less income, maybe they have $3,000, maybe want to keep them around 40 to 43% because they don't have a lot of extra money to make the payments. You follow? So it's all really based on what your income is, what your credit score is part of it, but that's not the only thing. And then what can you debt service? In other words, how much debt can you pay? And then down to debt to income and of course, your ratios. So that's exactly how most underwriting, it's called, is done to determine if you qualify for a loan or not. This is why you'll often hear people say, don't go buy a car until you've closed your house. Now, you got to subscribe right now, and then I'm going to tell you a story about a house that was lost from somebody who was very close to me and what happened, and it almost caused a divorce. So go ahead and subscribe below so I can help you to improve your wealth and improve your real estate investing, and you can learn how to earn. So what we're going to talk now about is my friend who I showed her what to buy and where to buy. It was a brand new home. It was pre-construction, so she got in while the house was being built. And as the house was being built, the price was going up. So her and her husband were super excited. They had the right credit, they had the right income, they had the debt service, they were self-employed, but they had tax returns which showed their income, so they were okay there, and then they had bank statements. So the income had to be verified. It will be for you too. Either show it or somehow show it on your tax return. So anyway, so they went to go buy this house. They were all excited. They picked out all their upgrades. Everything was great. They signed on the bottom line. Everything was good. It was a Thursday. Well, she went out of town for work for the weekend and came back on Monday, and guess what happened? Their loan got denied, even though it had already been approved and they signed the docs. Why? Because the lender had pulled their credit report. That's right, they re-pulled their credit right before they funded the loan, and guess what they found? The husband had bought a new truck over the weekend, and that showed up on their credit. And that changed all their ratios, okay? It changed everything. So they had to go back into underwriting and hold up the sale. Well, guess what? The truck payment was too much, and it screwed up all of their ratios, and they lost the loan. And she was ready to kill him, okay? She didn't kill him, and they were ready to get divorced, and they didn't get divorced. They stayed together. But these are the things that happens with lending, okay? They were going to buy this beautiful brand new house. They weren't able to buy the house because their husband, having signed all the loan docs, didn't know that until the loan funds, they could still go back and look at the credit. And if there's a new inquiry, which there was, and there's a new borrowing, it's going to change all these ratios. So the moral of the story is if you're buying a house, don't buy anything new until after you close escrow on the house. Then get furniture, car, whatever else you're going to buy. Once you've got the loan, it's been funded, and you've closed escrow, and you have the keys to the property in your hand. You know, that's a big lesson for a lot of people, and it's a big lesson for them. Most people don't know that they will recheck your credit. They will send a 4506, which is a form, the IRS, that you sign to confirm that the tax returns that you gave them are the ones that you filed. They will look into your income and make sure. In other words, this is quality control. This is all designed to protect you and protect investors who buy these loans to make sure everything is on the up and up and everything is as so it is stated, okay? But the last thing I want to say on this credit thing, even if you have a couple dinks, sometimes you can do a letter of explanation. It's a very logical explanation of why you had this problem, and the lender will make an exception and give you the loan even though you had an issue. Could have been a medical bill, could have been, an ambulance bill, could have been some situation where you got hurt at work and you weren't able to work for a while and you had some dings in your credit, couldn't pay your bill, had a disruption in your income like COVID recently happened. So these are all things that are considered when getting a loan. The bottom line is most people don't buy homes because why? They don't think they can, okay? They listen to everybody else out there who says, well, I don't think I have credit and my income and this and that, I'm self-employed. Look, stop, okay? You can buy homes. You may not be able to buy it right now, but you can work the process and get your credit up, get your income up, get your reserves up that you need. You need to have reserves, a couple months of mortgage payments in the bank. You can use your 401k to borrow for your first time loan in most cases. So there are options for you. The best thing for you to do is to go to a bank or go to a mortgage lender who's licensed and find out what your possibilities are. See, most people don't start, and that's why they never get anywhere, all right? So you have to start. You have to go in and find out, even if you're not going to qualify, so what? Find out, okay, if I can't qualify now, what steps do I need to take to qualify, okay? If I can't buy that $2 million building today, what steps do I need to take to be able to buy a $2 million building next year? If I can't qualify to get the house, can I get a condo or some other alternative, okay? Stop putting yourself down. Stop stopping yourself. The only thing stopping you is you. You go in, you find out what's going on with your credit, with your income, with your taxes, with everything. You put all, maybe 6 months you'll be ready to buy a home, maybe 6 weeks, maybe in a couple years. But at least you're making progress towards getting the loan you want for investment property or something you're going to live in. I'm Paul McGuire. Don't forget to subscribe. I'm here to help you earn and help you learn. Can you buy a house with no money down? Well, click to find out. We'll see you in the next video.